Howdy there, folks. Welcome into this 5-piece here today. It's a 5-piece. Yes, I got my energy recharged, had a nice weekend. Happy belated Easter to everybody that was celebrating this weekend. It was a nice long weekend. Hope you guys got your batteries recharged here today, okay? So first one, getting into small caps are going to outperform if interest rates decline. Looking forward to react to that clip there. Then we'll react to this 4-minute clip here. Don't see a way for rates to come down after strong inflation data. I think it's an important subject to speak about here. Here's why BMOs, this gentleman basically favors Nike and Lululemon. So Nike's a stock I'm buying very aggressively right now. So we'll speak about that. I'll react to that. Then we'll react to this 1-minute clip on Amazon. And then the last one up here is this 2-minute clip here on Citi downgrading tech stocks. I own a lot of tech stocks. I'm sure you might own a lot of tech stocks out there. So looking forward to getting to that one here today, folks. Okay, appreciate you joining me. I'll ask in return, smash that thumbs up button. Did you know less than 10% of people usually hit a thumbs up for us YouTubers? Help us out, man. We need better than 10%, okay? I appreciate each and every one of you. Thanks for being subscribed. Also, proud to announce for the first time ever on this channel, we have a 1-day sale coming up for the Patreon tier that's usually $125. We're going to do it for $69 for 1 day and 1 day only. It'll be April 15th. If you want to sign up for this deal, pinned comment down there, and when the deal drops, we'll send you over the link to access it. It is a 24-hour deal, and that's it. Access to my #1 stock market course ever, Becoming Master of Stock Market, access to see the moves I'm making in my Patreon portfolio each and every week, the buys and sells, and access to that Discord chat in there. All for $69. It's a holy smokes. This ain't no jokers deal, okay? Haven't done a deal in there in a long, long time. Since last year, actually. So, all right, guys, let's get into this.
Aperture investor, I don't want to put words in your mouth, Peter, but I think you think we're restrictive. I think you think that we are slowing a little. You're seeing it somewhere. As a result, we will see some cuts, and that's going to make small caps just take off. Do you need to even say anything now?
I do think that.
Can you fill in the blanks?
Fill in the blanks.
Convince me well, number one, convince me you're seeing pockets of weakness in the economy. Where are they? And why aren't they obvious to everyone?
Well, I think when it's obvious, you have a recession or you have significant decreases, but you can see earnings growth slowing, particularly in the small cap space. If you looked over the last 2 quarters, you saw retail stocks, consumer discretionary stocks having slower growth over that time period. And even the large cap stocks, what Andrew referred to, the Magnificent Seven, whose revenues continue to grow at faster rates than everybody else, we see that evidence that's actually there. And there are some stocks that have actually reported that, small cap stocks have reported that in the next few quarters, they think their revenues are going to accelerate. And so, there's a feeling in that sense that executives think they're at the trough. And if, in fact, you're going to have lower rates, and if, in fact, over the last 2 years, higher rates have restricted growth and caused small cap to underperform large cap by 9% per year for 3 years, big number. And over long periods of time, small cap and the S&P basically are equal to each other. Vols are different, but, you get equal returns. There's really no reason to believe that if interest rates are going to decline, and we're not going to have a recession, and we could, but if we didn't, small caps are going to outperform.
I guess the if is if interest rates are going to decline.
Well, yeah, so a lot of hoops to jump through there, okay? So hoop 1 to jump through is you got to kill down inflation enough where the Fed says, okay, we can start cutting, right? 2, you got to avoid the recession if you want small caps to roll, right? Small caps aren't just going to magically go up. If you have big recession and let's say the NASDAQ's falling big and the S&P 500's falling big, that would hurt the Russell as well, and it would hurt small caps as well. So you need to avoid those 2 issues. And I mean, if you could avoid those, if we can have strong economy, low unemployment, inflation at 2%, rates being cut left and right, sure, small caps can roll, right? But at the same time, it's not as perfect as that. We might have one of those things play out or 2 of those things play out, but maybe not all the things, right?
Because we thought 6, and then maybe 5 cuts, and then, maybe we'll get 3. And now there's people saying, I've had people say we'll get 1 cut. I don't even know why you would cut 1. That makes most sense. But that's assuming that the next move is not an increase if inflation stays bad or even comes back.
Yeah, I think there's no chance for an increase.
And we are restrictive now.
Yes, I think there's no chance for an increase, but the Fed is in definitely a tricky situation.
Last words.
If they cut rates too quickly, then and inflation accelerates, that's a terrible place for
Is
them.
your whole thesis based on them cutting for small caps?
Yes, I do think that the Fed has to cut at some point. And my thesis is that they're not going to increase rates. My thesis is that they will be slow in cutting rates. I've said that for
Why cut it
years.
all? Because you do see, you think that there are
Because you have an
weakness.
unnaturally high cash rate. You don't need cash rates at this level unless you are attempting to restrict growth. And so there's every reason to believe that they will cut rates and get down to a
Even
normal
with
position.
inflation pointing in the wrong direction. I mean, the numbers we got on Friday, the PCE.
Well, the numbers are erratic. They're not, they're not just going up and they're not just going down, and we'll see what the numbers are this week.
Hold your horses. Hold your flip and flatjack and horses. Let me push back in at him. Okay, we can say the same thing in his pockets of weakness in the economy, right? We can say the same exact thing. Well, those numbers are erratic. Like, if you want to play that game, you got to play it on both sides.
Going up, and they're revising the last several months even higher.
Some of the revisions have been higher, and look, I'm the first hawk on inflation sticky. And people said inflation is just going to fall like a rock, and it never has, and I didn't think it would. But I do think you've had 2 years.
Well, no, technically it did fall like a rock. It went from 9 to 3 pretty dang quickly. But the problem is now we're stuck in the threes, okay?
Restrictive activity here, and you're going to, you're beginning to see breaks in the broad economy. I had Altice last week, the largest capitalization structure in Europe, was downgraded to CCC, and that's a major company. We're going to see more of that. We've seen banks struggle. We've seen real estate struggle. There are things out there that are obviously impacted by higher rates. And so we need to see consistency in the data, and the Fed said that. And that's not, don't be confused over that. That's what they mean.
Do you worry about stagflation?
No, I'm not worried about stagflation. If I have a worry, it's that we have a recession. That would be my concern.
The move we've seen in the markets,
I think you got to at least be slightly concerned with stagflation.
to what?
Well, again,
Not now,
if
but
you look
thinking
over
in the future.
time, the markets are not really outperforming by that much. In fact,
They finally caught up after a couple of years.
yeah, in fact, from end of 21 till today, I think the
They're not up
compound
that
growth
much.
rate is like 6% or 7% or even less. I think it's 4%. So it's not like the market is,
But
going
was it
up.
the expected easing? Was it the strength of the economy as far as earnings? What was it sentiment was so negative. It was the most hated bull market in the world last.
Yeah, but also, another factor to push back against them again here is if you're going to say, okay, the market hasn't done that well over the last 2 years, well, also keep in mind interest rates are not where they were at the end of 2021, right? We had rates 0 then. We have rates at 5.5 now. So what you're willing to pay for stocks in a market where, interest rates are 5.5 versus 0 should be less in theory.
The entire year, right?
Yeah.
I don't think you were very bullish for a while.
Yeah, it took me a while to churn, but I think in the last 6 months, the markets look attractive enough to invest in over the long run. And I do think the Fed is going to have to reduce rates.
Dude, sir, the market's always attractive to invest over the long run. You were bearish, supposedly, it sounds like, and now you flipped bullish here somewhat recently. The market's always attractive for the long term. If you got a 5, 10, 20-year outlook, it's always attractive. It doesn't matter where things are at. That's just ridiculous.
And if you don't have a recession, which we could, but if you don't, then I think the market's cheap.
Do you think that there's some Keynesian benefits going on? I don't know whether, the worry about Keynesian benefits is that they come due at some point down the road. There's no free lunches. But do you think some of it is all the money allocated for chips or infrastructure or EV transition, any of that stuff? Is that all that money sloshing around still?
Well, I definitely think that some part of the fast rise in inflation was a reaction to COVID and the fiscal stimulus that was created.
Is that some of that still around?
And yeah, sure, but it's less than it was, and it's petering out. You see consumers increasing their borrowings. One of the great benefits we got out of very low interest rates is, I don't know what the percentages are, but they're 60 to 70% of homeowners have incredibly low interest rates on mortgages.
True.
At 3.2%. And so if you think about the discretionary income that creates at the consumer level, that's significant, and that's still there. That's not going anywhere. And people are...
If you own a home. The problem is not everybody owns a home that has, a 3% something mortgage on it.
Control of that. If they want to sell their homes and pay higher rates, they can. But if they don't, they'll continue to have that discretionary income. So I do think that that's helping this situation. I think that's helping the Fed keep rates higher and slow the economy down. And I do think that that may be one of the reasons why there's not a recession.
That's the last thing I was going to ask you about. I forgot.
It adds to the inequality, though. It adds to the inequality. People who are first-time homeowners.
Sure,
people
absolutely. Absolutely. And that's one of the reasons why, actually, if you get to some stability, you actually see a pickup in housing, because there are a lot of first-time homeowners who haven't been able to buy, and because prices have been elevated. And that, there is pent-up demand. You'll get the rental markets. That's part of the reason why inflation doesn't come down that fast.
Right.
Because people have to rent.
When are we going to see some crowding out in terms of if we got every time we do another auction for the $33 trillion, you wonder, how do rates come down? I mean, it'd be nice because the debt service would be, but how do we get people to take the paper with lower yields?
Well, so let's talk about where we are in the yield curve. So now you're talking about further out in the yield curve, not the short paper. So the question is the 10-year at 4.2% fairly priced? And can you really get people to buy all the paper they have to buy at 4% or 3.5%? And personally, I've never thought that. I actually think that the U.S. government's going to have to pay up.
It still happens.
And it's still happening. And I think you've got to get 150 to maybe 200 basis points of real interest, real return.
To go 10 years.
And so if you have a 2%, inflation rate, you're going to have 4 or, at least 3.5. And so I don't think it's any surprise at all where we are in the 10.
So you're talking about short rates coming down, but
short rates will come down.
And long rates could go up then.
Long rates could go up. And you wouldn't be shocked if they did.
No.
Because what if inflation sort of bottoms out at 2.5? And you have a 2% real rate, that's 4.5. And 4.5%, 10-year Treasury, that's not even unusual. In fact, a 4% Treasury at 10% rate is more unusual.
So the gentleman brought up some good points there, and some other points I wasn't the biggest fan of. Don't see a way for rates to come down after strong inflation data. Okay, this should be interesting.
President Sri Kumar, Global Strategies, former chief global strategist at TCW. Sri, it's great to have you. Interesting day to have this discussion because KRE is under some pressure in light of the strong data that we got today.
Yeah, KRE is under pressure, and we got the manufacturing numbers called, which were much better than expected, the first upturn since 2022. And yet, we had the markets looking for a quick rate cut. You wonder, with a strong economy, inflation being above target, and as I wrote in a weekend piece, several disappointing numbers about last Friday's inflation figures, I don't see a way for the rates to come down. And keep in mind that rates have increased substantially in the last couple of years. And that's why we have two problems. One, banks which bought bonds at 2% 10-year yield, thinking it was going to go to 1%, because Chairman Powell told them that inflation was likely to be transitory, are now finding the assets are underwater. Second, the commercial real estate situation is having a double whammy. Higher interest rates they have to pay their bankers, and again, work from home phenomenon put together. These are the two areas in which you can have the next explosion taking place.
I was going to ask you about the second.
This is why they say it's very, very important everybody understands this, okay? There's a saying in the stock market, the Fed won't lower until there's an accident or the economy tanks, and it's obvious, right? Until there's an accident, like something really big happens as far as in the banking system or something like that, way bigger than what we've seen in the past with Silicon Valley Bank and some of the 2022 stuff, right? Or actually that was 2023 stuff. We got to see bigger, with something way bigger than that for the Fed to say, okay, we're going to lower rates. Or a situation where it's obvious the economy is struggling. It's not obvious right now, right? You can get a weak number here and there in regards to the economy, and then you get some other number that's great. And people are like, oh, okay. Like, it has to be obvious, unfortunately, for the Fed. And like really, really obvious. Look at how long it took them to raise rates. I mean, to a lot of folks, it was already very obvious. And it has to be like, everybody knows it.
There's been some interesting polling out of Gallup last few days looking at the ways in which work from home, really 2 to 3 days a week in, is where companies are finding the best engagement with their employees. So are you saying it's more of those secular trends that are going to bite the sector?
I think it is a secular trend, Carl. And following up on what you said, I don't think it is just a short-term phenomenon, because everybody is adjusting to working 2 or 3 days in the office and the remaining days at home. Second, you can, even when they work 2 or 3 days, you don't need an office of your own. Your office or your cubicle can be shared by others. So that again means that even if you return to work, there is going to be less demand for space. So you have to have a structural change in real estate by which the prices go down significantly, and that is already starting to happen. But here is the big difference that can cause a problem for banks, that some of this, more and more of the real estates are going to come into the market in 2024, 2025, which means that you cannot pretend that your assets are still worth 100 cents on the dollar. You have to write them down. And if you have uninsured deposits, people are going to watch it, and there is a risk of further deposit flight, a repeat of what we saw in March of last year.
That's a great point. Great point.
I guess the counter argument, Sri, is that we know all this. It's been like this slow-moving train wreck. We know all the exposures. Banks have had to, for several quarters now, state their commercial real estate exposure, their office exposure, because investors are requesting that kind of information, and it's out there. We know there's going to be a big adjustment for it. Banks have been preparing, and investors are tuned into it.
But you make an excellent point, Sarah. The difference is the following, that you have had a massive amount, something like $250 to $300 billion due during 2023 are being postponed to 2024. So the amount due is going to be substantially greater in the current year. Second, you can only extend and pretend that you don't have a problem for some period of time. And I think the banks have done enough of that last year. So this is probably the year in which reality is going to strike. Third, you can pretend as long as you have assets marked at 100 cents on the dollar. My experience goes back to the Latin American debt crisis, Sarah, in the 1980s. And the banks for a long time valued those assets at par. But then a secondary market developed, and you found Mexico and Brazil trading at 30 or 35 cents on the dollar. Yeah. Then you were forced to mark it down. That was the third reason why I think 2024 is going to be a decisive year for commercial real estate.
Interesting gut check, Sri, especially in light of what the Fed chair has said about the fact that there will be failures, although in the Fed's view, maybe more manageable. We'll talk about it, I'm sure, again. Thanks so much, Sri Kumar.
Thank you so much.
So good points overall. Really appreciate his input there. All right, now let's get into Nike and Lululemon. And I am buying Nike very aggressively right now. Why am I doing it? The reason is the stock's extremely undervalued as a long-term investor. So let's get into this one.
You're not turned off by recent reports from, say, Nike or Lululemon.
Love you calling out the page count, Sarah. The question is, how far do we get? Good to see you. So I think, listen, there have been so many conversations since Nike and Lulu reported, and all of them center around the fact that the stocks went down, meaning that the consumer is not doing well. You and I were talking about Nike right as it hit. The North America number was great. And the Lulu North America number also grew 9%. And so I think it's important to acknowledge there's the stock price, and then there's what are consumers actually spending. And by and large, across a broad group of consumer discretionary stocks, average revenues were up 4 or 5% this quarter.
Yeah, but to push back against you, sir. First off, Nike numbers were not great in North America, in my personal opinion, as a Nike shareholder, as somebody that's actively buying the stock. And I'm buying it because of what I think the company will produce next year and the following year and so on and so forth, right? But short term, like, those numbers weren't great out of North America, in my personal opinion. Secondly, Lululemon, sure, 9% growth in North America. What were they growing last year at this time? 29%. So we're talking about a night and day difference there, right? Where it's like, wow, what a massive deceleration. Where's the company going next? 5% growth, 3%, 1%? That's what you got to start thinking, right?
But isn't the thing that consumer is being burdened by the cumulative impact of inflation. Consumer is changing as a result of COVID and post-COVID and travel and prioritization and groceries. And ultimately, it's just not going to result in the high growth rates that we saw for this category and these brands, past, say, what was the peak, 2021?
So I think everything you said I agree with, and I think that's exactly the point. We're looking back at the 21 peak. At some point, we have to look forward. And so at the end of the day, there's been this fear since 21 that every single consumer discretionary stock was going to have its Peloton moment, right? Another one you and I have talked about a lot. And so what that means is we had optically or artificially high revenues. People spent a lot of money. They had stimulus. They had desire to spend. There's so many reasons that 21 was the best retail probably era we will ever have. And then it followed by among the worst. Now we're back to some sense of normalization. And so I think we've been waiting for that last shoe to drop. We've been waiting to hear that all of the macro factors that you just noted that are true, right? There's no question people should be feeling that pinch, but they're still spending. And so I think there's this interesting dynamic. You and I talked about this at the beginning when the rate conversation started. All of a sudden, we're going to spend more. The problem hasn't been spending. We see that in the revenues, and I think that's important to keep in mind.
But there are also questions about, so if we're choosier with where we're spending, you really have to delight the consumer. And there are innovation questions, certainly at Nike, that other analysts have raised. It's something Nike itself has even acknowledged. I think in the last conference call and in some of their releases around restructuring and refocusing on growth areas where they've lost share, running, women's. I mean, we talk about Hoka and on. It's more competitive right now. And there are questions about whether Nike can still beat the competition on some of those core categories.
Yeah, Deckers, which owns Hoka, is not beating Nike long term. No, I'm sorry. Deckers is not beating Nike long term.
And yet, they did $5 billion of revenue. They watched the North America business grow, materially beat expectations. And by the way, they did it at a great profit. EBIT margin North America was up a lot as well. And so it's this really interesting dichotomy. And so that was why this note became 35 pages, because I think we walked in with all of those same feelings of the world is tough and all these macro factors are bad. And we can hear about the fact that on a company level, the innovation isn't there. All of that is true. And yet, EBIT dollars for Nike consolidated entity grew 23%, I believe, last quarter. So there's this element we have to sift between the narrative and the numbers because the narrative has taken over dramatically. And that's the reason Nike stock is where it is. But Nike's numbers show a different story. And so that was what we were trying.
But all due respect, this gentleman's definitely cherry picking some data here, in my opinion.
No, that was what we were trying
Making
to
Nike
tease
sound
out.
way better
Sometimes
than it was.
with a sector that's as accessible as retail is, it's very easy to go along with the story. And so taking that step back and looking, okay, so here's a business that watched its North America beat and grow, and it's the largest footwear retailer around, right? That's massive. Say they grew, do it at a healthy margin. And it's not just North America. The total EBIT of the company, the total operating profit of the company grew over 20%. That's better than most of the other companies I can see, and yet the stock went the other way. I like that divergence.
Yeah, so, obviously I love Nike for the long term. I'm buying the stock very aggressively because I think, 2025 and beyond will be tremendous for the company. But that being said, the short term numbers are not great out of Nike. I mean, they're great if you compare them to other companies, sure. But you got to compare Nike to itself. And are Nike numbers impressive versus Nike? No, not right now. Okay, so they got a lot of changes they're making to the business model. The numbers will get great, but let's not fabricate and act like right now it's great.
If you're going to get Mag 7, Fab 5, whatever it is, Super 4, I don't know, you need pieces like Wells today, which is that Amazon numbers are too low, and does point out that generative AI and Anthropic that got that position will matter.
Are Amazon numbers too low? Obviously, I'm a big Amazon shareholder. My opinion on if Amazon numbers are too low is, yes, they are too low. Across the board, revenue estimates too low for this year and EPS estimates are too low for this year, in my personal opinion.
But there's just, the advertising business is on fire there. That's the story. They're doing more than $50 billion run rate. That doesn't cost them anything.
There's another Q2 pick on half of Wells this morning.
Yes, and
Amazon.
I think that piece should be read, okay? It should be read because it reminds you why you're in. one of these stocks because the number of options they have to make money is extraordinary.
Speaking of some of that, Jim, we did learn today that FedEx failed to renew their service contract with the U.S. Postal Service.
But UPS is down too. People, the long knives are out for UPS. People just don't like it. But FedEx, Superman had an amazing quarter. So if he didn't want that contract, then that contract's a loser.
How about tonight?
Okay, so this is a very exciting night for me because I have Jack.
Okay, so that covers that. Okay, next one up here, Citi downgrades tech stocks.
Citi is downgrading some elements of tech today, as well as a bunch of other key sectors. Scott Croner, Citi's U.S. equity strategist, joins us this morning. Scott, great to have you. I was looking through your note this morning. You mentioned that some of the downgrades are mechanical in a sense. Can you explain?
Sure. So, for example, with tech, which we've taken from a long-standing overweight down to a market weight, we remain overweight software. We're market weight semis, but the hardware component is what we're moving down to an underweight. What that does is, from a balancing perspective, it brings our overall sector call down to a market weight, Carl.
Does that mean the locus of the downgrade is in sort of telecom communication services?
Yeah, so what we're really trying to get at here is that we think this broadening thesis that we've been on for a number of months now, Carl, is beginning to evolve further, okay? The growth leadership has been very clear and well identified, but if you look at the performance over the past month or two, you've begun to see value kicking in very slowly and quietly as an outperformer versus growth. What we're doing with our sector calls going into Q2 is acknowledging that the broadening we've been calling for, which is a barbell of growth and cyclical.
Depends where you look for value. Consumer value, not really. You know, you look at the stocks like the McDonald's, Starbucks. You look at stocks like Nike, like we just spoke about, right? Traditional dividend value play. So, which obviously is not performing well. So, yeah, it depends on where you look specifically.
Now can go down a defensive path, and what we're focusing on here, most importantly, are the perceived beneficiaries and the eventual Fed pivot and lower short-term interest rates. That drives consumer discretionary moving higher, courtesy of an autos upgrade from underweight to market weight. It also drives our increased positive view towards utilities and even staples.
But what if that all gets pushed out, Scott? A day like today, for instance, yields are higher. We got better manufacturing numbers, prices paid, which people look at for inflation, firmer than expected. Yields are up and values breaking down. Couldn't that happen?
Yeah, well, it can, Sarah. So, I mean, that's a tricky one. So, in the meantime, our Lefebvre index has moved into euphoria. Combined with our fair value work, it's suggestive that from a broader perspective, we have to be wary that sentiment is in a fairly euphoric area. I think clearly in the market's mind, this mid-year Fed pivot, which should be during Q2, let's presume, is going to be your focus point. The consensus is for 3 rate cuts this year. Citi Economics' view is for 5. But if you do go down a path where you get
5 rate cuts, I mean, what? 5 rate cuts, is that realistic? It's realistic if you expect the economy to crash this year, sure. But I mean, you know, with inflation data where it's at, we're now going into April, with the market trading where it's at, 5 rate cuts, you got to expect the economy to crash. And then I don't know why you're at 5,100 if you're expecting the economy to crash, because then you need to be down to 4,500, 4,000.
Number of Fed rate cuts or even a lack of a pivot, I'd say that probably brings our euphoric concern back into play.
Interesting note, Scott. We'll hope to dig into it a little bit deeper with you next time you're on set. For the time being, we'll say goodbye. Scott Croner of Citi. Thanks.
Alrighty, guys. Appreciate you joining me. Thanks so much for being here, as always. Once again, April 15th is our one-day sale. If you want access to that, pin comment down there. Put in your email. We'll send it over when that deal drops. It's a one-day sale. And also make sure you create a Patreon account after you enter in your email and name. And the reason being is you can't get the deal without creating a Patreon account. It's free, but make sure you do that, okay? All right, guys, much love and have a great day.